Imagine you're about to make one of the biggest financial decisions of your life, but you have no idea what the right choice is. You're staring at forms, terms you barely understand, and debt numbers that make your heart race. You keep asking yourself, what's the smartest way to borrow for my education without drowning in debt later? Today, we're breaking down student loan options for complete beginners. And stick around, because near the end, I'll reveal one hidden detail that could save you thousands of dollars over the life of your loan, something most borrowers don't find out until it's too late. Number 1. Federal student loans, your safest starting point. If you're new to borrowing, federal student loans are usually the safest and most beginner-friendly choice. They're backed by the USA government and come with protections you won't find in private loans. This includes fixed interest rates, income-driven repayment plans, and even the possibility of forgiveness if you work in certain public service jobs. For example, let's say you borrow $20,000 in a federal loan. Your interest rate is fixed, meaning it stays the same for the entire loan term. If your income drops after graduation, you can apply for an income-driven repayment plan that adjusts your monthly payment to match what you earn. Compare that to a private loan where your interest rate could spike after a few years and there's no guarantee your payments will adjust to your income. Number 2. Subsidized versus unsubsidized loans. Know the difference. With federal loans, you'll often hear subsidized and unsubsidized. Here's the deal. Subsidized loans are for undergraduates with financial need, and the government pays the interest while you're in school and during certain grace periods. Unsubsidized loans are available to more students, but interest starts adding up from day one. Imagine you borrow $10,000 in a subsidized loan. While you're in school, you won't owe a penny in interest. Now imagine the same amount in an unsubsidized loan at 5% interest. By the time you graduate, you could owe hundreds more before you've even made your first payment. Number 3. Private student loans. When they make sense, private loans come from banks, credit unions, or online lenders. They can be helpful if you've maxed out your federal loan options and still need more money. But they're riskier for beginners. You'll usually need a good credit score or a cosigner to qualify. Interest rates can be fixed or variable, and repayment terms are less flexible. There's no federal forgiveness program for private loans, and income-based repayment is rare. For example, if you borrow $15,000 from a private lender with a variable rate starting at 4%, that rate could jump to 8% or higher over time. That's a difference of thousands in extra interest. Number 4. PLUS loans for parents and grad students. PLUS loans are federal loans designed for graduate students or parents of undergraduates. They have higher interest rates than standard federal loans, but still come with federal protections. Let's say a parent borrows $25,000 in a Parent Plus loan to help their child avoid private loans. They'll get a fixed interest rate, access to deferment options, and the ability to consolidate with other federal loans later. But they also need to be ready for larger monthly payments and stricter credit checks. Number 5. Understanding interest rates and fees. Interest rates determine how much extra you'll pay on top of the amount you borrow. Federal loan rates are set each year by Congress, while private loan rates depend on your creditworthiness. For example, a 5% rate on a $20,000 loan over 10 years means you'll pay about $5,456 in interest, but at 8%, that same loan costs over $8,987 in interest. That's a $3,531 difference, just from the interest rate. Also, watch out for origination fees. Federal loans have small fees deducted from the loan before you receive it. Private loans may have none, but could make up for it with higher rates. Number 6. Repayment plans. Flexibility matters. Federal loans offer multiple repayment plans, like standard repayment, graduated repayment, and income-driven repayment. This means you can adjust based on your income and career path. Example, under the standard plan, you might pay $200 a month for 10 years. Under an income-driven plan, your payment could drop to $80 a month based on your earnings. Private loans usually don't give you this flexibility. You're stuck with whatever you agreed to at the start. Number 7. Forgiveness programs. Free money if you qualify. One of the biggest benefits of federal loans is the possibility of loan forgiveness. Public Service Loan Forgiveness, PSLF, wipes out your remaining balance after 10 years of qualifying payments if you work in public service. Imagine becoming a teacher, making payments for a decade, and having the remaining $15,000 of your loan forgiven. That's real money you don't have to repay. Private loans don't offer anything like this. Number 8. Borrowing only what you need. It's tempting to take the maximum loan offered, but more money borrowed means more money owed later. Figure out exactly how much you need for tuition, housing, and essentials, then stick to that amount. For example, if tuition is $8,000 a year and housing is $6,000, don't take $20,000 just to have extra spending money. That extra could cost you thousands in interest over time. Number 9. Cosigners, help or hazard. With private loans, a cosigner can help you qualify or get a lower interest rate. But if you miss payments, your cosigner is equally responsible, and their credit can take a hit. Imagine your uncle cosigns your $15,000 loan. If you fall behind, he's on the hook. That could create family tension you can't put a price on. Number 10. Scholarships and grants. The free money strategy. Before taking any loan, search for scholarships and grants. They don't have to be repaid and can reduce or even eliminate your need for loans. For example, a $5,000 scholarship could mean $5,000 less in debt and hundreds less in interest payments. Combine several scholarships, and you might cover your entire tuition without borrowing a cent. Number 11. The hidden detail that can save you thousands. Here's the part most beginners never think about. You don't have to wait until graduation to start making payments. Even small payments while you're in school, like $25 a month, can save you hundreds or thousands in interest over time. Especially with unsubsidized and private loans, where interest builds from day one, this strategy can stop your balance from snowballing. Number 12. Loan consolidation, combining your federal loans. Loan consolidation lets you combine multiple federal loans into a single new loan with one monthly payment. This can make repayment easier to manage, especially if you have several loans with different due dates. For example, if you have 3 federal loans with payments totaling $300 a month, consolidation can combine them into a single payment, possibly with a longer repayment term to lower your monthly cost. But keep in mind, extending the term means paying more interest overall. Number 13. Refinancing, lowering your interest rate. Refinancing is when you take out a new loan with a lower interest rate to pay off your old loans. It's available through private lenders and can save you thousands in interest. For example, refinancing a $30,000 loan from 7% to 4% could save you over $5,000 across the life of the loan. But here's the catch. Refinancing federal loans with a private lender means losing federal protections like forgiveness programs and income-driven repayment. Number 14. Grace periods. Your payment-free window. A grace period is the time after graduation before your first loan payment is due. Most federal loans give you 6 months, and some private loans offer similar terms. Use this time wisely. Start budgeting, look for a job, and consider making small payments to reduce interest. For example, if you have $20,000 in unsubsidized loans, paying just $50 a month during the grace period could prevent hundreds of dollars in extra interest from building up. Number 15. Deferment and forbearance. Temporary payment pauses. If you face financial hardship, deferment or forbearance can pause your payments temporarily. Deferment is better because in some cases, the government pays the interest on your subsidized loans during the pause. Forbearance lets you pause payments, but interest always accrues. For example, losing your job might qualify you for unemployment. Deferment on federal loans, helping you avoid default while you get back on your feet. Number 16. Credit score impact. How loans affect your future. Your student loans play a big role in your credit history. Paying on time can build a strong credit score, helping you qualify for lower interest rates on future loans, like a mortgage. But missed payments can hurt your score for years, making borrowing more expensive. For example, one late payment reported to the credit bureaus can drop your score by over 50 points. Number 17. Loan limits. Knowing the borrowing cap. Federal student loans have annual and lifetime limits, so you can't borrow endlessly. For example, dependent undergraduates can borrow up to $31,000 in total, while independent students have higher limits. Knowing your limits can help you plan ahead so you don't run out of federal loan eligibility before finishing your degree. Number 18. Fixed versus variable interest rates. Choosing wisely. Fixed rates stay the same for the life of the loan, while variable rates can change over time. A fixed rate offers stability. You always know your payment amount. Variable rates may start lower but can rise, making your future payments unpredictable. For example, a variable rate starting at 3% might seem attractive now, but if it climbs to 7% in a few years, your monthly bill could jump by hundreds of dollars. Number 19. Loan servicers. Who you actually pay. When you take a federal loan, you don't send payments directly to the government. You pay a loan servicer. This is the company that handles billing, payment processing, and customer service for your loan. Knowing your servicer is important so you can track your payments and understand your repayment options. For example, your servicer might be Nelnet, Mohila, or Aidvantage, and each has its own online portal for managing your account. Number 20. Emergency funds, a loan safety net strategy. It might sound strange, but having an emergency fund while repaying loans can save you from missed payments and late fees. Even $500 set aside can prevent you from defaulting if an unexpected expense hits. For example, if your car breaks down and costs $400 to fix, your emergency fund covers it, so you don't have to skip your loan payment and damage your credit. Every borrower's situation is different, but the basics are the same. Understand your loan types, know the terms, borrow only what you need, and take advantage of every federal protection and free money opportunity you can find. So, if you were starting college tomorrow, which loan option would you choose and why?